Because mortgage rates have been so high, home buyers have been literally scouring for ways to get that payment down. And there's a good way to do it. And this is the video of today. I want to talk about a program called 3% Lower. I literally wrote the book on this. It's nothing that has been hidden from the general public for years. It's just a simple temporary buy down. But there's a way to structure this in which you as a home buyer or you as a home seller can help sell your house, but the home buyer can get that lower payment for the first 3 years of that mortgage. It substantially lowers the mortgage payment, and with the whole goal being making the house more affordable. So in today's video, I wanted to go through from a real life example of how this works. I'm going to go through the program. I'll show how the payments break out, and then I'm going to go into detail of actually how to negotiate a 3% lower into your offer. Okay, let's go ahead and take a look. This is a conventional loan with a $500,000 sales price. The borrower is putting 10% down. And I've priced this rate out today, and these are basically the 3 rate options. If you, by the way, want a copy of this spreadsheet, you can simply just click the link in the description, fill out a very short form, and I'll send it over to you. It does have 3% lower already built in. Okay, so these are the 3 different options, and you basically just choose from here which option. I just chose the 6.99, just looking at what the payments are. As you can see, the payment is $34.64. Now that's pretty darn high given where rates are right now. And a lot of home buyers are like, well, I just don't want that payment. I was really kind of hoping for $2,500 a month. Well, okay. Well, you can dream now because enter 3% lower. The idea of this program of a 3-2-1 buy down, temporary buy down, is that we're lowering your interest rate for the first 3 years of the loan. 3% lower the first year, 2% lower the second year, 1% lower the third year, and then whatever the normal rate is for the years 4 through 30. The idea being that something in life will change by year 4. Either rates are going to go down, which I highly believe they are. Anyways, you can refinance that mortgage, or hey, maybe your work situation will change and you will make more money down the road. Maybe you'll have more equity and you can refinance and get rid of mortgage insurance. There's a lot of ways to skin the cat. However, now is the time that people need the payments lower, and this is a really great way to do that. Essentially, what you're doing is you're taking the cost of buying the rate down for the first 3 years and you're building it into the sales price. Okay, so this money is actually built into the sales price and it's paid for by the seller. The seller is not really technically paying for it because you're building it into the sales price, so they kind of walk away even. What happens to you is you have to increase the sales price, therefore you're owing more on the mortgage. And you're like, well, Rick, why is that a good thing? I'm just kind of delaying the inevitable. But the idea is this: that money that we're building into the sales price that you think is like, oh, well, I just paid too much for this house. That's actually money that's your money. Consider it this way. Instead of paying $500,000 for the house, I'm going to build into that mortgage, I'm going to build in a higher sales price. And what I'm going to do is I'm going to stick that money that I overpaid for the house, right? I'm technically overpaying, and I'm going to put it into an escrow account. That money is my money. So all we're doing is we're simply allowing the bank to give me financing that's more creative, allows me to lower my payments for the first 3 years of the mortgage. And something I couldn't do otherwise if I didn't structure it like this. So this is the end result. So 10% down on $500,000, you can see your payment is $34.64. You say, okay, that's too high. I say, great, let's do 3% lower. This is how it would work. Your interest rate would go down 3% for the first year of the mortgage, taking your payment from $34.64 down to $26.19. A little bit more palatable, isn't it? Year 2, your interest rate would go from 3.99 to 4.99. I'm on the second year of my 3-2-1 buy down, and my payment would go to $28.86. Year 3, my interest rate would go up 1%. The third year of my 3-2-1 buy down, and my payment would be $31.68. And then if I kept the loan and kept it like normal, it's $34.64 year 4 through 30. Very important to note, this is not an adjustable rate mortgage. These are all your monies that you're using for your buy down that is fixed. It is not fluctuating. This is not going to change from one year to the other. This is on a very scheduled plan. This is what it is year 1. This is what it is year 2. This is what it is year 3 and year 4, so on. People ask me often, well, what happens if rates go down in a year I want to refinance? Or if I sell the house, what happens? Well, guess what? Any unused portion of your buy down funds goes back to you. So all that money is yours. No matter how you cut it, it's your money. If you refinance after year one, you've probably got about half of your buy down funds remaining, and that'll come back to you. In fact, it'll actually go directly towards the principal balance you'll owe less, and that'll help pay for closing costs on a refinance. If you sell, all that money comes back to you because they apply it towards the payoff of the mortgage. So pretty cool. A lot of ancillary benefits, but before I get into that, I'll talk about the benefits of this on both sides of the equation. But let me go ahead and how to negotiate this. So step one, and I see this mistake made a lot, people trying to negotiate buyer or seller concessions because you need seller concessions. In this specific offer, you would need about $21,000 in seller concessions. Now, I round up. My spreadsheet rounds up on purpose because you have to have it paid by the seller. You can't just like, whoops, you're a little short, you're short and you can't do it. So there's nuances. So we want it all paid for by the seller. So I typically take the amount it costs to buy down for 3 years and I just round up. And I round up the nearest whatever 1,000 it is. So that's what I've done here. As you can see, for a $500,000 house, my net offer to the seller is $479,000. So if I were to say, well, wait a second, the seller wants $500,000 and I've agreed, I think we can agree to $500,000. Well, that's what you do. We start and we negotiate your offer without the concessions. You just negotiate it. You get under contract at $500,000. After ratification, you're going to submit an addendum raising the sales price enough to fund your buy down escrow and net the seller the same as you previously agreed upon. For example, if I agreed upon a $500,000 house, what I'm going to do is I'm going to adjust my sales price upwards in order to compensate the seller exactly $500,000. So all I do is I just kind of back into it. Let's just go up 520. Well, that almost gets me there, 498. No, I got to go up a little bit more, so 522. There you go. So with a 522 sales price, I net the seller $500,000 and I now have my 321 buy down. As you can see, the sellers, you're paying them $522, they're giving you $22,000, they still get $500. You see? But now what it looks for you, instead of paying $3,600 or almost $3,500 in the previous example, you're now paying $2,700 a month. And this money, this $21,532, goes into an escrow account with your name on it. And for a 10% down, this is how much money you would need at closing. And so the spreadsheet kind of does all that work. Now you can play with the spreadsheet, and I don't want to really get too much into this. Higher rates mean lower upfront costs. Lower rates mean higher costs, more cash to close. So I'm just going to kind of leave it at the 6.99 because quite frankly, I think 3.99 looks pretty cool. Anyway, but this is how much money you use every year on the buy down. So in year one, I'm using $10,586 of my buy down funds. So if I were to pay off the house at the end of year one, I would actually get back, what is that, $10,945. Or if I refinance, that would go towards my principal. All right, so let me get to the next step. This is important. We want to include in the addendum, so we have the addendum to raise the sales price enough to cover it. So we're raising the addendum, we're raising the sales price to $522. Buyer and seller agree to make the sales price $522,000 with $22,000 as a seller concession to pay buyers allowable closing costs. That's what you would say. You can either put that as in the same addendum, which I would recommend, or you can even do a separate addendum. I've seen it done both ways. But step 3 is that you want to include an addendum that says all commissions and appraised value requirements are based on the initial sales price. What's that mean? That means that the realtors are not getting paid on 522, they're getting paid on 500. That means the home doesn't have to appraise for 522,000, it only has to appraise for 500,000. And this is a video for another day, but I mentioned here, very important, before signing anything, you want to have a backup plan should the home not appraise for that higher sales price. Let's say it only appraises for $500,000. What's that do to you? Well, the lender is only going to loan you a percentage of the appraised value, not the sales price. So if you jack up the sales price too much, let's just say you're in a competitive offer situation and you got to go above the sales price just to complete step 1. And then you go back and say, hey, I want to do a buy down. And they're probably going to look at you cross-eyed and you wait, you want to increase the sales price more? Yeah, I do. And so as long as you make it comfortable to the seller, knowing that, hey, we're doing this for my loan purposes. It has nothing to do with my qualifications, the appraisal, the real estate commissions, any of that. It's just simply me being able to do this buy down. Okay, the last thing I wanted to show you on this spreadsheet, and people love this, is that what happens if rates go down? What does this look like from a refinance standpoint, considering my overall mortgage payment? And this goes into how long really am I going to probably want to keep this 3% lower? And the answer is about 2 years. Because if you look at this, if I have a 1% reduction in mortgage rates from 6.99 to 5.99, which I feel is highly likely over the next 12 to 24 months, this is what's going to happen to my mortgage payment. It's going to go down about $308 a month, and my total all-in payment would be $32.53. If I look up at this guide as to where that's going to put me, it's going to put me about year 3. If the rates do fall, year 2 is about where you're going to want to start making this decision whether or not I want to refinance or not and apply the remainder of my buy down funds towards refinancing. So I really hope this was helpful. I know I kind of went off on a talk track about the benefits and whatnot, but it's safe to say that this program is helping making housing affordable again, which is the whole idea. Buy downs are nothing to be scared of. They're very simple to negotiate, and don't let anybody tell you you can't do it because the home won't appraise. That actually has nothing to do with it. Unless you're absolutely strapped for cash, putting no money down on a VA loan or like scraping to get 3.5% on an FHA loan, you don't have to worry about this. Anyways, if you have any questions, please don't hesitate to schedule a call with me. I hope this video was helpful, and I will see you on the next video. Take care. Bye.